Bruce Kasman is the chief economist at JPMorgan. And Bruce, we want to bring you in to talk about you're seeing some more potential fallout for the global economy from these energy shocks.
Well, we think there's a real tug of war going on right now. I think the global economy is actually showing a healthy amount of momentum as we make our way through the first quarter. U.S. growth, as you noted, was okay, but there's really strong tech demand, and that's driving growth in a lot of other places, particularly across Asia. I also think there is a sentiment lift that's been taking place on the business sector side that's starting to lift labor demand. And I do think we're going to see U.S. job growth get back above 100,000 a month in the next few months. But that's coming against the back of a building energy price drag and a real tension here, because as we continue to keep the strait closed, we're starting to draw down inventories. We're starting to potentially run into some physical constraints in places like Asia. And perhaps most importantly, at some point, if we don't feel that this conflict is going to get resolved, there's a risk of a scramble for oil, which is going to start to create nonlinear price increases.
Right.
So we think the global economy is at a crossroads right now.
And we had Darren Woods on this morning, the CEO of Exxon. He warned that we could see an increasing impact on price.
Well, that's the point. I think most oil price shocks we've seen in the past, the first thing that happens is people scramble for oil. This has been really unusual in that supply has come down and we're drawing inventories down. People are expecting this to be resolved very quickly. But that creates a tension. If expectations start to shift, if we continue to linger with the strait closed, you do run the risk that something shifts behaviorally that creates nonlinear moves on price.
When you say nonlinear, I think about Japan. I was teasing about this a little bit earlier on, but they're having to defend the currency. We're seeing global bond yields back up, sent interest rate policy a little bit askew. What should the Federal Reserve do here?
I think the Federal Reserve is doing the right thing. It's expressing patience. And I think the Fed will continue to, in the context of two-sided risk. I think there's more concern that other central banks, I think the ECB, perhaps at the top of the list, starts to get nervous. They have more concern about their inflation targets, and they begin to move rates up. But the Fed is an anchor here. And I do want to emphasize it's an anchor for a lot of other central banks. It's an anchor for what you're seeing in the equity markets. I don't think the Fed is going to break from that. But I do think we should understand that if we get through this, we're going to be sitting with energy prices more elevated. We're going to be sitting with 3% inflation as a more persistent part of the environment. And probably if we're right that labor markets start to improve, the weakness in supply suggests that the unemployment rate is going to start to drift down. So in our forecast, the Fed is a very important support right now. But looking forward 6 or 9 months in the constructive scenario, the Fed's going to have pressure to hike rates.
I follow Jim Paulson's work still. You probably know him well, Bruce, from over the years. But he recently was kind of jumping on the bandwagon of saying, look, yes, we have 3% inflation, but if we keep rates where they are, if they're somewhat restrictive, if you were to perceive these as, kind of price shocks, we could be holding back the U.S. economy. Would you be sympathetic to the idea that even against those scary headlines, 3%, because this is acting as a drag on the consumer and ultimately maybe something bigger, would looser rates be appropriate?
No, I don't think so right now. I think we have an environment in which the economy is doing okay. It's got imbalances in terms of the components of demand, but it's doing okay. I think we're starting to see some cyclical lift in hiring. It's not going to be dramatic, but the problem is we have a very weak labor supply with tightness there, and we have persistent 3% inflation. I think the right thing is for the Fed to stay on hold now, balance the risks. But I do think the pressure, if we do not have a more serious energy price shock to deal with, is that the pressure is going to lean in the direction of the Fed having to think about raising rates.
All right.